In this short video, we will discuss the oil markets. We will touch on the instruments that are used to trade the oil markets. We will discuss oil market dynamics and the risks that are inherent within oil transactions. Commodities are a broad-based asset class ranging from well-known financial products to less-known physical products. The most actively traded commodity group is the petroleum market. The risks on oil products within this group include physical storage risks, basis risks, transportation risks, and intricate market directional risks. Oil is traded globally, but many of the same products that are traded around the globe are not fungible. In general, oil is a leading indicator for both inflationary times when markets are expanding, as well as deflationary economic environments when the markets are contracting. Oil is a physical asset, and therefore there are risks that are not seen in stocks, bonds, and currencies. Oil is the largest input fuel used to power transportation and manufacturing across the globe. Financial instruments are the most liquid of the global commodity products, but there are substantial physical product markets that are conducted between counterparts along with broker conduits. Each market trades in a different manner, and the nuances need to be studied prior to engaging in transactions. The most liquid of the commodities is oil, which is traded as a futures contract, along with having a presence in the ETF market and the over-the-counter and physical markets. Theoretically, the futures markets, along with ETFs, remove the credit risk from oil trading. Futures are generally cleared through regulated clearing exchanges, such as the Chicago Mercantile Exchange, where segregated customer funds are margined to facilitate transactions. Recently, the system has been put to the test as the bankruptcy of MF Global created a huge customer deficit as segregated customer funds were loaned to cover MF Global's corporate liabilities. Oil, as mentioned, is traded globally 24 hours a day, 6 days a week. The majority of the oil trade is transacted through financial markets via futures contracts, over-the-counter agreements, or physical contracts. The futures market are dominated by the New York Mercantile Exchange and the Intercontinental Exchange. Both exchanges offer contracts on benchmark West Texas Intermediate along with North Sea Brent. The majority of crude prices are created as a basis to one of these two benchmarks. Historically, the only risks associated with futures has been market and liquidity risk. The oil market is relatively volatile, with historical volatility running near 40% on average, with peaks as high as 100%. The futures market, or for oil, which exists in the US, UK, EU, Japan, Singapore, and Australia, is a leverage market in which exchanges monitor positions and generate margin calls if funds fall below a specific threshold. The CME, for example, monitors positions and margin using their spam risk array, which is an intricate way to generate risk profiles on margin accounts. Although benchmark oil prices are liquid, there are many basis oils that are opaque. Many commodity portfolio managers use benchmark WTI or Brent to hedge position in less liquid oils, creating an illiquid basis that needs to be analyzed. Other types of tradable petroleum products include gasoline and distillate fuel. Distillate includes heating oil and jet fuel, which is also traded on major exchanges. These products also trade as a spread to benchmark crude oils and are driven by supply and demand of the end consumer. Financial oil trades are leveraged products where investors can place initial margin of approximately 10 to 15% of the value of the contract down to control a physical contract. For example, a trader who wanted to buy one crude oil contract that has 1,000 barrels would need to post enough money to pay for 150 barrels. Physical oil mostly trades on a cash basis. The largest issue related to physical oil is the actual specification of the grade of the oil received. Investors looking to benefit from oil storage or transportation should have access to experienced inspectors who can determine if the products are reliable. Financial oil markets settle differently than compared to other financial instruments. Oil contracts on the New York Mercantile Exchange are generally physically delivered contracts. This means that the financial instrument becomes physical oil when the contract settles. Investors who are not willing to take physical delivery need to exit these types of contracts prior to the delivery notice date. Another difference in financial oil markets is that many of the contracts settle on a financial basis that is calculated on an average rate basis. This means that the settlement prices are average prices based on daily settlements over a specific period of time. In most cases, this period is a month, but it can be a quarter or a year. This type of settlement, known as Asian or average price settlement, removes some of the volatility inherent in oil market price action. Options are available for oil and petroleum products and have risks that are different than most financial products. The most liquid options are Asian style options, which are average price options. These options have a different linear approximation when compared to European or American options, where volatility is somewhat muted due to an average calculation. Portfolio managers who are generating oil options risk need to monitor the specifics of numerous types of options available in this sector. In addition to European, Asian, and American style options, many exchanges offer options on oil spreads. This means that for an investor or commercial entity to trade an option on a calendar spread of oil prices, they would need to be able to formulate the concept of being able to buy a call or a put on a June contract relative to a December contract. These types of calendar spread options add an additional risk component called correlation, which is added to the bivariate Black-Scholes model to create the value of the spread option. These types of options also exist when comparing heating oil or gasoline to crude oil, and there are spread or crack options in these products available on regulated exchanges. The oil market is a vast and complex marketplace, and portfolio managers should be aware of all the risks inherent in the market prior to initiating risk.